Why financial freedom is harder than you think. It is a well-known fact that the education system is severely deficient in financial literacy, and a significant number of individuals enter maturity without a comprehensive understanding of the concepts of asset management, budgeting, saving, and investing. It was not until I was 25 years old that I began to study the workings of money. Despite my father's success as a business owner, I was never instructed on the subject of money, including its creation, investment, and debt management. I was frustrated by the constant feeling of being stuck in occupations that I did not enjoy, the lack of savings, and the uncertainty surrounding my future when I began my own family. I was aware that I needed to make a change, so I began to read everything I could about money. I have always maintained the conviction that we are responsible for our decisions and our future. If I were to achieve success, it would be entirely up to me. The following are a few of the books that I have read and will be rereading this year. They have been instrumental in my successful financial journey and will be beneficial to you as well. Robert Kiyosaki's Rich Dad, Poor Dad. Robert Kiyosaki is a renowned entrepreneur and investor who is recognized for his advocacy of investing in tangible assets that generate income, such as real estate and enterprises. This book fundamentally altered my perspective on money and enabled me to comprehend how the affluent allocate their funds without exchanging time for it. In the book, Kiyosaki's Rich Dad employs him at a young age in his business and teaches him that being an employee will not enable him to achieve significant wealth and financial independence, as he is exchanging time for money to develop his father's business. He demonstrates to Kiyosaki that he instead acquires assets, such as hotels and real estate, by utilizing the money of others' debt and allowing others, such as tenants, to pay the debt on his behalf, thereby generating cash flow for his daily needs. It is an essential read for anyone who is dedicated to the development of prosperity and financial independence. Robert Castiglione's Lifetime Economic Acceleration Process. However, I was able to acquire a used copy of this book from Amazon despite its extreme rarity. The Elite Financial Planning Model, which was the first of its kind to adopt a comprehensive approach rather than exclusively concentrating on investment performance, was developed by Robert Castiglione. Robert is a highly intelligent individual, and the book was occasionally challenging for a novice like me to comprehend. However, this is the place where I first acquired knowledge about the concept of utilizing money as efficiently as possible, the 4 rules of financial institutions, wealth-eroding factors, and how to incorporate protection into a financial plan to ensure that it is effective under the majority of circumstances, not solely if all circumstances are favorable. He also clarifies that money is not a form of mathematics, and mathematics is not a form of money. Rather, money is a commodity that must be maintained in motion to prevent it from stagnating and dying. The 4 regulations of financial institutions are as follows. They require and desire our financial assistance. They desire it to be implemented consistently and methodically. They intend to preserve it for as long as feasible. They aim to offer as little as feasible in return. Financial institutions develop financial products and services that adhere to the 4 rules, as profitability is their primary objective. They not only construct their products and services to adhere to these 4 regulations, but they also leverage the government to establish new laws that align with their goals. He continues, it is not improper for them to pursue these objectives. It is their capitalist right, and we should all support their freedom to do so. Nevertheless, we are not obligated to forfeit our entitlement to ensure that our money is utilized as efficiently and effectively as possible. 3. Robert Kiyosaki's Cash Flow Quadrant. Kiyosaki goes into greater detail about the 4 categories of individuals who are actively engaged in the pursuit of wealth in this book: investor, business owner, self-employed, and employee. This is a visual representation of it for your understanding. Those on the left side are those who exchange time for money, while those on the right side have money working for them. Their income is not contingent upon the amount of time they work, which allows them to enjoy more time freedom and less reliance on retirement planning. 4. Kyle Christensen's Principles of Planning. Kyle has simplified numerous concepts that are taught and practiced by the world's wealthiest individuals in this book. I am currently rereading this book, and if I were to begin with a single book on money today, it would be this one. Kyle delves into the definition of principle, its role in directing our lives, and how we can apply principles to our finances to achieve financial liberation, which is the ultimate objective of financial planning. The process that this book teaches is the attainment of financial freedom, which is achieved when the income generated by our assets is sufficient to support or exceed our desired lifestyle. He elaborates on the 4 rules of financial institutions and how they promote products and strategies that benefit them. He argues that saving and investing are not the same thing, even though Wall Street regards them as the same. Financial independence is a process, not a destination that can be established and then forgotten, as Wall Street would have you believe. Hard work and dedication are essential for success in any aspect of life, which is why the reward is so much more satisfying. For those seeking financial independence, the following are several critical recommendations. Establish life objectives. What does financial freedom mean to you? Although there is a universal desire for it, this objective is excessively vague. You must establish precise deadlines and quantities. Increasing the specificity of your objectives increases the probability of their realization. Record the following 3 objectives. What is necessary for your lifestyle? The amount of money that should be in your bank account to enable you to do so. Which age is the time frame for saving that amount? Next, establish financial mileposts at regular intervals between the 2 dates by counting backward from your deadline age to your current age. In your financial binder, place the goal document at the front and meticulously record all deadlines and amounts. Establish a monthly budget. The most effective method of ensuring that all expenses are paid and savings are on track is to establish a monthly household budget and adhere to it. It is also a routine that strengthens your resolve against the temptation to splurge and reinforces your objectives. Complete the full payment on credit cards. Wealth building is detrimentally affected by credit cards and other high-interest consumer loans. Ensure that the entire balance is paid off each month. Typically, student loans, mortgages, and similar loans have significantly lower interest rates. The repayment of these loans is not an emergency. Nevertheless, it is crucial to make timely payments on these lower interest loans, as this will contribute to the development of a favorable credit score. Establish automatic savings. Pay yourself first, enroll in your employer's retirement plan, and take advantage of any reciprocal contribution benefit, which is essentially free money. It is also prudent to establish an automatic withdrawal from an emergency fund, which can be used to cover unforeseen expenses, as well as an automatic contribution to a brokerage account or a similar account. In an ideal scenario, the emergency fund and retirement fund funds should be withdrawn from your account on the same day that you receive your income, ensuring that they never come into your possession. It is important to remember that the quantity of money that should be saved in an emergency fund is contingent upon your circumstances. Additionally, tax-advantaged retirement accounts are subject to regulations that may complicate the process of accessing the funds in the event of an emergency. Consequently, it is not recommended that this account serve as your sole emergency fund. Commence investing immediately. People may query the wisdom of investing during bear markets, which are periods of low stock prices. However, there has never been a more effective method of increasing one's wealth. Compound interest alone will exponentially increase your wealth. However, it necessitates an extended period to accomplish substantial growth. Nevertheless, it is important to bear in mind that the type of stock selection that has been made famous by billionaires such as Warren Buffett would be an error for all individuals, with the exception of professional investors. Instead, establish an online brokerage account that simplifies the process of learning how to invest, establishing a manageable portfolio, and automatically contributing to it on a weekly or monthly basis. To facilitate your initial steps, we have compiled a list of the most effective online brokers for novice traders. Don't forget to like, subscribe, and drop a comment below. We'd love to hear your thoughts, and stay tuned for more content.